Here's the kicker. A fixed rate used to be a rock solid, safe choice. You lock it in, you sleep well, and you repeat. But in 2026, it is going to be different. The market, the economy, the rules, they've all shifted, and choosing a long-term fixed rate now could actually limit you and cost you more money than you actually imagine. Stick around with me today because I'm going to give you 5 powerful reasons why you might not want to lock into a fixed rate mortgage in 2026. And one of them, it could quietly add thousands to your cost or tie you down when you don't want to be there. Let's go. As always, everyone, I'm Alex. I'm a mortgage broker in the GTA and all of Ontario, actually, and I'm an Oakville and Toronto realtor. I help people buy and sell regular residential real estate, and I help investors invest in multiplexes and build their portfolios. So if you want to have a quick chat, just click the link in the description and book a call with me. And please don't forget to like, comment, and subscribe. I do want to hear your honest opinions on if you would go variable or fixed. Okay, it's time to dig in. And these are not generic disclaimers. These are things that I'm seeing with my clients all across Ontario right now. And if one of these hits you, you'll want to pay attention. Okay. So the first one is interest rate expectations are shifting. And here's what's going on right now. We all know that the Bank of Canada's policy rate is now 2.25 after that most recent bank cut. And meanwhile, fixed mortgages are tied to the 5-year government bond yields. We all know that. If you are fixed, the Bank of Canada announcement literally means nothing to you. What does it mean for you? If you locked in a 5-year fixed rate now, let's say around the 4% mark or whatever your lender is quoting you, you're essentially paying for today's expectation plus some cushion for the risk. According to the forecasts and the economists, the 5-year fixed rate isn't expected to drop dramatically, maybe move slightly downward. And if you believe interest rates may go down even a little or at least stay stable, locking in might cause you to pay more than necessary. Now, number 2 is variable rates and shorter term fixed could offer more upside with a little bit of risk. Fixed rate does obviously give you stability, but stability costs you. Variable rates or shorter term, like 2 or 3 years, often cost you less and give you more flexibility. Newer analysis suggests that variable rates have the potential to drop a little bit more or behave favorably, while fixed rates may have less room to go down. So here's an example. If you're thinking you might move in 3 to 4 years and you're just buying this house now, or you buy an investor property now and you might want to reposition it to buy another investment property, you might prefer variable or shorter fixed. That way you can pivot. Because if you lock in a 5-year fixed and then your plan changes, you've lost that flexibility. So one important caveat here, to make this strategy work, you must be comfortable with potential increases when the Bank of Canada makes their announcements and have the budget and income for that. The third reason you might not want to go fixed is because there are big exit penalties if you break early. And in the GTA market, whether you're a first-time homebuyer or investor, we know mobility is real. You may sell, you may upgrade, you may downgrade, you may convert the property. And in that 5 years, things can happen. So a long-term fix can lock you in. And if you exit early, you may face a higher interest rate differential or other penalties when breaking your mortgage. Whereas a variable rate mortgage or a shorter term fixed, you tend to have lower penalties and more flexibility. So if your plan is to not exactly stay 5 years in that property, then don't pick a 5-year fixed rate just because it's 0.2% less of an interest rate. Another reason why is you actually might move sooner than the term ends. So let's be specific here. For example, in Burlington, for a multi-unit property or for multi-unit investors that want to buy 3 or more, you might want to buy now and plan to hold for 2 to 3 years, then reposition and repeat. So if you choose a 5-year fixed, you can't refinance to take any equity out to go and buy your other property. And that misalignment can cost you that time if you do find another great investment property in a couple years and need to leverage the one that you're buying now. So honestly, ask yourself, how confident am I that I'll stay in the same place and use this mortgage for the full term? If the answer is even maybe not, fixed is definitely not your answer. Your financial life will probably shift. You might want to finish renovations or pull out equity or buy a second property, refinance, what have you. And if you're in a long-term fixed at a higher rate and rates drop or your plan changes, you pay the price. So it's either you stick it out or you pay the penalty. Forecasts show that fixed rates might not actually fall dramatically in 2026 and could actually trend up depending on global bond yields and inflation risks. So if your key objective is flexibility and to have options, locking into a long-term fix might reduce your ability when you need to act in the right moment. So here's the plain English takeaway. Fixed rate mortgages are a powerful tool. They give you predictability and stability and peace of mind because you have the same rate every single time your mortgage payment comes. But in 2026, given where we are, rates, economies, forecasts, and how you might want to act, such as move or invest and reposition, fixed is not automatically the default safe move anymore. And if any of these apply to you, like you might move or sell in 2 to 4 years, or you're an investor and you may want to upgrade or refinance or change strategies, or you believe that interest rates might actually come down a little bit, even modestly, and we're talking about the variable rate here, and you're comfortable with some rate risk and prioritizing your flexibility, then we should seriously discuss the variable rate or a shorter term rate, and if that fits your lifestyle. If you want zero surprises and have the exact same thing over and over again every month, or bi-weekly, whatever you choose, then obviously fixed is your way to go. And if you're watching this and you're thinking, okay, but what should I pick for my scenario? Whether you're a first-time home buyer, whether you're an investor and you're on your third multiplex property, or you have a renewal coming up, send me a message or click the link below and book a call with me, and let's map out your next strategy for the next term that you are headed in with your mortgage. But before we drop a comment below, what would you choose in 2026? Fixed or variable?